What's going on, everybody? Good evening. Welcome in, welcome in. We're going to get going here in just a little bit. Got Nando in the building. What's going on? Welcome in. Gustavo,
Hey,
good evening.
hey, Toasty, how you doing?
I'm good, man. How are you?
Not so great. I actually need some serious advice. I loaded Rivian heavy above 16, brother. What do I do now?
Oh, no, man. We're in trouble. We're in trouble. You're going to need to get out the checkbook.
Nah, I'm joking. I haven't touched this stock in a while. Since the last time it gapped down on me, I was trading options on it. Thought the flow aligned with the trade. The chart looked good. It's not one of those that is under my radar anymore. I'll leave that up to you, all right, big man?
All right, that sounds good. Yeah, thankfully I was off it before earnings. It's going to need a whole lot of time to clean up, probably. Yeah, but that's all right. What's going on, Manny Carr? Nice to see you again. Cecilio, that is exactly what this lecture will be like. So you are in the correct place this evening. And we're going to give it just a couple more minutes before we get started, but that is exactly what we're going to be talking about tonight. Today is going to be starting out like we have never heard. I mean, it's going to start so basic, like you've never even heard about the stock market before. So this is going to be pretty good. It's going to really start from the basics. And again, this is our beginner course series. So it's really meant to build you up from nothing. So yeah, it's really going to start from the basics. And if you know nothing, this is really the best lecture to start from. And even those who are a little bit more advanced or have a little bit more knowledge, this is still really excellent to refresh your knowledge and maybe learn something that you didn't already. So we're going to get started in a couple of minutes and I'll introduce this a little bit more officially, but this should be a good one. How's everybody's day been today? Anything special you got up to? Anybody take any interesting trades? Tesla puts. Oh, you started reading the book by Al Brooks. Oh, which one, man? Some of those books are pretty brutal. Those books can get really, really deep into the weeds. Sometimes I try to I actually haven't even read Al Brooks's books. I've only watched his videos, but man, I can imagine his books get pretty insane. Oh, reading price charts bar by bar. I actually want that one. I haven't taken the leap to buy it, but I actually do kind of want that book. I feel like it's probably pretty good. Let me know what you think about it when you're done with it, Cecilio. I'd be interested to hear a little bit more about your review. But yeah, I mean, Al Brooks, obviously, stock market day trading legend. The guy, I mean, I'd put him in the same category as, Livermore, Wyckoff, those types of people. Um, I mean, he's pretty legendary if you ask me. When there's an alert and it's too expensive for your port, what would be the best choice? Look for a less expensive call or a cheaper alert. Yeah, generally speaking, the analysts alert, various contracts for specific reasons. So, like for example, Flips is taking those closer to the money contracts for a reason, right? When you're day trading things with short amount of time, you really want to be generally a little bit closer to the money in case things go out of your favor. Or in the case they do go in your favor, but slightly, you have that larger delta in order to capitalize on the smaller move. So generally speaking, if you see an alert that's on the edge of you being able to afford it in your portfolio, it's generally best to probably stay away. Um, Especially if it's a stock that's reasonably more expensive, like for example, something like maybe an Nvidia level expensive, or at this point an SMCI level expensive. Generally speaking, it's probably going to be better for you to just stay away from that as a whole. Um, rather than trying to find a cheaper contract, only because just because a contract's cheaper doesn't mean it shares the same quality as the more expensive contract. So you got to be real cautious doing that type of stuff. All right, well, it's a couple minutes after the hour, so I think it's definitely safe for us to get right into it. So, yeah, without wasting any more time, let's get going. So, welcome into the lecture, everybody, for the evening. For those of you who don't know me, my name is Toasty. Been giving lectures here for over 3 years at this point, so a little bit of experience doing this type of stuff. And I'm excited to say that today is going to be the first lecture in our beginners course series in a long time. The last time we ran the beginners course series was back in, oh man, I think it was maybe the end of 2022 or potentially the beginning of 2023. But either way, it's been a long time since we've ran the beginners course series last. And this time around, I wanted to update some of the content, make things a little bit better. And overall, just represent it, give all of our new members an opportunity to attend live, get some of their questions answered. And yeah, that's the big idea. So today we're going to be talking about the basics of stock options. Now, before we get into the lecture, I wanted to just give a little bit of an introduction into how I like to run these lectures and the type of pace that you should expect in these classes. So some of these classes that are a little bit more heavy on the PowerPoint, you can expect to be structured almost like a college or yeah, I'll call it like a high school or college lecture, where we spend a lot of time kind of introducing concepts, working with you guys on different examples, and increase difficulty as we progress throughout the class. And sometimes I start to speak a little bit too quickly, or I don't cover things in as much detail as I should. So if you have any questions that come up, feel free to just go ahead and throw that in the chat, and I'll do my best to get that. If I miss it, just go ahead and throw the question in the chat once again, and try and make sure that I don't ignore it or miss it the next time. But again, happy to have all you guys here live. All these lectures are recorded, so you should see this lecture posted on YouTube in the coming days, so you don't have to worry about that. If you have to leave or can't stay the whole time, it's not a problem. This is going to be posted on YouTube for you all to see. Now, that said, the beginner course series is structured with 12 classes, and this course series will take place over a period of probably 3 months, because we'll have some maybe podcast lectures mixed in with these to kind of break it up a bit. But this is really the general course outline for the beginners course series. And previously, when I first started this, it was only 4 classes. I think last year we changed it to 10. And I think now it's at 12, or maybe it was at 12 last year, and I just have it more clear this time around. But we're here right at step 1, talking about the stock options basics tonight. Next week, we're going to move into talking about the Greeks, so some more detailed properties of option contracts. Then we're going to talk about candlesticks, support and resistance, price action and volume, indicators. And then starting with the second half of the course series, we'll move into trends, patterns, the sectors of the market, advanced technical analysis. We'll talk through price targets and positioning, and speak a little bit more about the deeper meaning and some advanced subjects regarding price action. Now, a lot of courses here, but the overall goal and what you should expect to get out of attending these next 12 lectures by myself is ultimately you should find yourself to become a successful trader who can find and execute on the highest probability trades and act on those opportunities with confidence. And this is something that I've seen happen with so many people that have attended these courses. And I guarantee that those who are dedicated to the classes, attending live, answering questions here week in and week out, and studying charts are almost certainly going to feel the same way by the time we're done with this course. And it truly is structured in a way that will bring you from the ground up. And I pride myself in the way that it's structured, because I really do think it's structured. I think it's structured similar to a college course, but also much better than anything you'd be able to get in college, because nobody would teach you about technical analysis. You know, that you'd probably be able to learn this first lecture in college. And I personally did have a class in college that covered some of the topics in the first lecture. So I did my best to structure this first lecture in kind of a way similar to college, and cover some topics that are a little bit less relevant to trading in specific, but super relevant to the market and just understanding, stock market topics in general. So a whole lot of value in this course series. I mean, certainly, I'd like to think that attending these courses alone would make your membership worth it. I think it's something that people would charge a whole lot more money for. But again, I'm a little bit biased. You know, I'm the one that developed the material and teach it. So obviously I'm going to think it's good. But the real judge is going to be all you, to hear about your feedback and your thoughts as we move through the material. So this is the big overview of the course. Does anybody have any questions before we get started? I saw one, will this be every Wednesday? Yeah, generally speaking, these classes will be every Wednesday, same time, 6 p.m. Pacific, 9 Eastern. Next week, actually, I think I will be out on Wednesday, funny enough. So this will probably be on Monday next week. But generally, all these lectures are going to be on Wednesdays. Norvin, probably no opening range breakouts today, unfortunately. That'll probably be in lecture 5. Today, we're going to keep it real basic, Norvin, but still, it'll all be relevant for you, I promise. Cool. All right, let's keep this rolling. We got a lot to cover in the next hour. So let's cover our goals for today and what you should all expect to get out of this class. And again, as I mentioned, you should expect to see a lot of my courses structured in this way, where we cover and recap where we're at in the larger kind of catalog of courses, and then drill down and really dive into what we should expect to learn from this class in general and some outcomes for the end of the class. So the 2 main topics is really going to be introducing the overview of what the stock market is, how it moves, and some principles behind it. And then finally, we're going to talk about what options are. So what the contracts mean, how to understand them, how to buy them, how to sell them, understanding a couple different properties of them, like understanding the pricing, understanding the strike price, and other different specific properties of option contracts. And the goals for this class is, number 1, you should understand the basics of the stock market. You should understand how the market moves, and you should have a good idea of what the option market theory is. And then number 2, you should have a good understanding of what options are, why they exist, and the types of things that you can do with options. That's the big idea for the class. For the next couple pieces, it's really going to be a lot of me talking and asking you all questions. So it's going to be pretty heavy on material today. But as always, I try my best to start with some of the easier stuff at the beginning as we move into a little bit more difficult concepts. But overall, this class is generally pretty simple to start us off. So should be a good one to ease you into it. Me personally, if I was taking this class again, I probably would be writing notes. I don't know if notes work for all of you, but it might be something useful to use for your own review/studying. So with that said, let's move on to topic 1, which is, what is the stock market? And before I move into the section, I want to just pose the question to all of you. How would you define what the stock market is, or what do you know about the stock market as you stand today? Go ahead and throw a couple answers in the chat for me, and let's see what you guys are thinking, get everybody warmed up. What do we think? What is your guys' opinion? What's your guess if you have no idea what the stock market is and somehow you ended up in this Discord? Or what's your best guess? What's your best definition? Where companies get funding? Yeah, that's not a bad guess. Buyers and sellers. Yep, definitely buyers and sellers in the stock market. Yep, place where you trade shares. Certainly. Place to trade equities. Yep. Oops, I didn't mean to do that. Yeah, all a place to donate your savings. Yeah, hopefully not to donate your savings, or CEOs avoid taxes. All right, great answers. The definition that I came up with, and I think this one was pretty much scraped off some website, is any marketplace where the trading of securities occurs. And you'll see a lot of the definitions that I provide in these lectures are usually pretty broad. And that's because a lot of the terms that we introduce could mean a lot of things to a lot of different people, and it really makes more sense to keep things more high level than specific. So this definition is essentially saying that a stock market is any, I'll call it, facility where we can exchange securities. A security could mean a lot of different things. It could be a bond, it could be a share, it could be an option contract, it could be a futures contract, etc. Right? So a security could mean a lot of different things. It could even be a stock option, maybe. So a stock market allows us to trade all of these different things on an open marketplace that we can all access. And just to provide this little image that I thought was pretty interesting, another couple definitions. I don't really care too much about the stock index one, but the stock market and stock exchange differential I found pretty useful. So the stock exchange is actually where the I'll call it the exchanging happens. So where the shares exchange hands. And the stock exchange is made up of different groups of firms. So that might include market makers, that might include other types of hedge funds or firms that are facilitating transactions, maybe the clearing houses. And then we have the stock market, which is where we go to buy and sell these shares. Our orders get routed to the exchange where the exchange of shares actually takes place. And then they come back to us in our portfolio. So that's kind of the flow where we place orders on the open market. Those orders are routed to an exchange, and the exchange is where the order and transaction is facilitated. So for example, we go on Robinhood and say, hey, we want to buy 1,000 shares of SPY. And Robinhood says, great, I'm going to send that to the best exchange at the present moment, which might be NYSE, it might be the NASDAQ, it might be ARCA, a bunch of different exchanges that transactions may occur. So that order gets sent to the exchange and it gets fulfilled as quickly as possible, depending on the type of order that you placed. And then the exchange handles all the processing, all the back end stuff, the transaction. And then you just get the shares in your portfolio and have to deal with the paperwork at the end of the year when your tax form 1099 comes in. So that's the big idea on kind of the flow of information and transactions in the market. And then finally, a theory that I really want to kind of convey is the auction market process. And I think this helps make the stock market a lot more digestible and really understanding what it truly is. So one way that you can think about the stock market is a bunch of competitive buyers and sellers. And if you compare this to a real auction market, right, buyers would enter competitive bids and sellers would submit competitive offers at the same time. So for example, if I was going on eBay and trying to buy a PS5, I might go put in a bid for $200 and the seller might have a list price at 500, which would be their current offer. And maybe they negotiate with me and they drop down to 400. And maybe another buyer comes in and says they'll pay 250. And then I'm like, well, I'll pay 275. And we start to get more and more competitive as the spread narrows. So the stock market essentially operates very similar to an option, because if you think about it, a stock price, or the price at which a stock trades, represents the highest price that a buyer is willing to pay and the lowest price that a seller is willing to accept. So what that means is that that bid price, which maybe you've heard before, maybe you haven't, is the most that a buyer will pay for that stock at any given moment. And we can even look back at the charts really quick and you can see maybe just barely in the top left there, the bid under that B is 500.66 and the ask is 500.73. So at the present moment on SPY, the most any buyer on any market is willing to pay is 500.66, and the best price any seller can currently offer is 500.73. And those are real-time offers, and really seeing that auction market happen in real time. And as I just kind of mentioned there, the stock market can have numerous buyers and sellers all looking to make deals simultaneously at any given moment. So as you can imagine, we just looked at the auction process for just the SPY, right? And you can see here that bid now dropped from 500.63. Now it's down to 0.61. We could look at QQQ, which trades 24 hours, and you can see the current price spread there, where the bid is 431.35 and the ask is 431.40. And you just saw that bid move up there to 0.36 for a second there. And if we look at the futures contract, this will probably move a little bit more quickly, where we can see these bids and asks come through. As you can see that change, I know for those on mobile, it's probably kind of difficult to see, but we can see these auctions taking place in real time, where the 5028.75 is currently the average price being transacted at. And we have the best price our buyers are willing to pay and the best price our sellers are willing to offer. So I personally find that it's very helpful to think of the market more as an auction, because it really helps you understand the psychology behind trading stocks, which at its core is incredibly important. And one anecdote that I'll share is, long before technology and computerized trading, all trading happened on the floor of an exchange, which is in person. And I'm sure many of you have seen the pictures, and I could even probably look one up, NYSE exchange in the 1970s. If I look at a picture, you can see these are all the stock traders trading over paper and whatever else, and people routing orders. And oh, these aren't routing orders. This is somebody literally displaying the price on before the ticker tape. And you can see all these people trading orders or trading shares and all these different images. And if we look back at probably the exchange in, let's see, 1972, when the stock market began to crash through that oil situation, which maybe that's one of them. Essentially, the way that you could tell what the auction in the market was doing is you could hear how many people were yelling to buy or sell something. And you could judge the aggressiveness of buyers or sellers based on how many people were yelling to buy or how many people were yelling to sell, or you could see how many people were frantic on the trading floor. So it's really interesting to see how that type of behavior has now translated to us looking for volume in computerized charts, right? Where previously, if you're on the floor of the auction market, where you're at the exchange, you're hearing people buy and sell stocks, you can tell how aggressive people are, right? Because you're there in person. And if, for example, if I went, if we had this lecture in person and I was offering PS5s for $100 and all of you guys really wanted the PS5, I'd be pretty certain that every single one of you would be jumping out of your seat to buy it, because I don't play PS5, but I'm pretty sure that's a pretty good price. I'm pretty sure they sell for $500. So if I offered you one for 1,000 or 100, you'd probably be really excited. There'd be people jumping out of their seat to buy them. And then if I said, "Oh, I'm actually going to sell the PS5 for 1,000," you guys would all probably go silent and wait for the price to get better. And we can really see that same behavior reflected in charts in the market. And really, the whole purpose of this course series is going to be to get us to be able to understand charts on a deeper level so we can look at these charts and we can understand where buyers and sellers are more aggressive. And we can look at a chart and say, okay, if we were in the 70s on the trading floor, we'd be able to tell that sellers are screaming to get out here, or we'd be able to tell that buyers are screaming to get in here, or buyers are screaming to get in here, right? Or there's no buyers here, no more sellers here. So a lot of different ways to think about the market, but I really do think that this auction market theory is kind of a helpful analogy. And just to kind of further the same idea, there's this kind of analogy to a car auction, which maybe is more relatable to some of you. So, for example, let's say this car is I don't know a Prius or a Honda or something, right? And the list price is 35,000. But for example, all of a sudden, people just gotta have this Honda. Maybe it looks really cool. Maybe it's limited in supply, and all of a sudden that creates an imbalance where the price goes up, right? So let's say, for example, there's so many people that want that Honda, but supply hasn't increased. So there's no new Hondas being made, but all these people want this Honda. Well, the price is going to go up, right? And let's say, it ends up stabilizing at this new price of $40,000. And all of a sudden, maybe let's say Honda decides to start making a bunch more of these new cars. So then there's more available and the price doesn't need to be as high because you need to be able to sell more of those. The demand is the same, but now we're getting more supply. So those buyers can be fulfilled. And then the price would settle lower at some point. And the stock market behaves in the exact same way, where for a while, an equity might trade in a given area. For example, maybe we could take a look at something like Shop. So here you could see, we clean this up a bit. Shopify, for example, traded a long time in this $30 to $40 range. And all of a sudden, we got this positive earnings report here, which would be considered a market event, right? Which created this buy imbalance, right? So we can see the auction market theory take place here, where here in this chart, right? And again, I know not everybody might understand charts, but really just trying to connect everything back here. Here you can see kind of that same graphic where this might be that fair value range. This would be that market event. We have another maybe market event that brought us lower here and another market event bringing us higher. So we found maybe some fair value in this area, right? So this is the big idea. There's different events that move markets. You can see here, all these events here at the bottom are all earnings reports, and you can kind of tell how these were some significant turning points here and here. These two earning reports for Shopify, really big turning points. And also we can see at the bottom, significant amounts of volume coming through following these reports. So really interesting way to think about things. I personally find a lot of value in thinking about the market, or at least when I was really trying to internalize this auction market process, I really did find a lot of value in comparing it to the market and thinking about it in this way. But that brings us to the end of section 1, which was our introduction to the stock market. Before I move on, does anybody have any questions or comments? This was a brand new section. So this section has never been seen before in any of the beginner course series. So what did you guys think? Did that make sense? Was that a good introduction? Was that clear? I never taught it in that way before. I mentioned those things, but never really had this kind of presentation to back it. So yeah, exactly, Cecilio. It's the concepts of supply and demand. Absolutely. Any questions, comments before we move into options? Crystal clear. Would you say a spike in the end of day today is a market event? Absolutely. And the market event was NVIDIA earnings, right? NVIDIA reported earnings today. So the spike across tech stocks across the board is due to a market event, right? So the auction market today found value, fair value to be somewhere around this 424 area on the Qs. All of a sudden, market event, which is that NVIDIA earnings, which essentially moves that fair value higher, right? All of a sudden, there's a new reason to buy. So it changes the supply and demand imbalance. How long in between market event that makes it go fair value? Yeah, very excellent question. And there's no defined time. And I wouldn't focus too much on that specific behavior. It's really just understanding the concepts that, and there's not always going to be an event that you're aware of too that's a cause. Like, for example, here in specific, I don't think there's any real, I'll call it market event besides rates moving lower and the potential for a Fed pivot. So that said, it's not always going to be cut and clear, buy signal. Sometimes it might be a technical market event where we're breaking out of this 4-month downtrend, we're holding above it. That would be considered a potential change in market dynamics and a new market event that could be a trigger for a move higher. All right. So moving on into section 2, which is what are options? And I want to kind of pose that same question I did when we started section 1. And let's drop it all on you. What is your opinion of what options are? I mean, what do you guys think they are? Does anybody have any guesses? Does anybody know or think they know? Throw some answers in the chat. Got to see some opinions before we move on. Movement on buys and sellers. The right to buy or sell. Ooh, nice answer. Contract to buy a stock at a certain price. Nice answer. I like that answer. A lot of people don't realize that. Wow, right to buy or sell 100 shares at a certain amount. I'm surprised so many are aware of that. Buying a portion of the share and then option to sell or buy, buying or selling fraction share. A lot of reasonable answers. A lot of reasonable answers. Some a little bit off, but I think we'll be able to clear that up in this next section. Yeah, great start, everybody. So let's talk a little bit about the basics of options. As you may or may not know, there's 2 types of options. There is call options and there is put options. Call options typically, and notice the word typically, gain value when the underlying or the stock price increases, and put options typically gain value when the underlying price decreases. So just to recap again, call options generally increase in value when a stock price moves higher, and put options generally increase in value when a stock price moves lower. And I added this word typically in very intentionally. Just because a stock price moves higher does not mean that option contracts will make money. For example, NVIDIA is up from 674 all the way to 735 in the after hours. But if we take a look at the options chain, they reported earnings today, and the implied move on earnings was about $66, about $66. And what they did so far looks to be right about 62-ish dollars. So they didn't quite beat the implied move. So the options market was expecting the stock price to move $66 in one direction, right, as of today. And that might not fully reduce all the way down. So there's a chance that it still could have beat implied moves by some metrics. This is a little bit more of a crude calculation. But generally speaking, the option market expected a move going into the earnings report. So just because the stock price went up does not mean that all contracts are going to be gaining value. For example, if we take a look at something a little bit more unreasonable, like these 1,000 calls trading for 88 cents or 88 bucks, these contracts are probably going to be worth under $30 tomorrow, if I had to guess. And the stock price will be, let's see how many percent higher. About 10% higher. So the stock price might be up 10% into tomorrow, but some of these calls will lose a massive amount of value. And the reasoning behind that is something called implied volatility. So the unfortunate reality is the options market and market makers aren't dumb. They understand that when stocks report earnings, they generally move much more than they do on average. So as a result, some of that movement is already priced into the options contract. That's to protect market makers because they know on earnings, it's essentially would be free money if they never expected a movement, right? Obviously, stocks move on earnings, right? It's a no-brainer. Stocks are going to move on their earnings report. That's what they do. So that's one kind of caveat to why you might not make money on an option contract just because the underlying price of a stock went up. Now, that's going to be a concept that we continue to revisit more in the next section. We talk a little bit more about the mechanics behind that, but that's the big idea that's important to be mindful of, especially after we come out of NVIDIA earnings today. And I wanted to just present this graph really quick. This is kind of a P&L chart of what your kind of return might look like on a call option. And I wanted to just break down this chart a little bit. So when buying to open options, you essentially pay money for them. You buy them like a product. So for example, I take $300 or $500 out of my portfolio, and in return, I receive an option contract. So as a result, the most amount of money that I can lose when I am buying an option contract is the money that I spent on it. It's just like any other obvious investment. Like for example, if I put in $100,000 to buy a new house, the most I could lose on that house is $100,000 because I physically did not put any more money in that than $100,000 unless I got some crazy funky loans and got myself screwed in other ways. But keeping things simple here. So that's what you can see here in this max loss section is $500, which is in this example, the amount of money that this person would have paid to purchase this contract. Here you can see a break-even cost and a kind of place where the slope of this P&L chart begins to change. And I'm going to break that down a little bit more in the next couple of slides, but I just wanted to mention that this is the price at expiration. And as a result, when an option contract is essentially expired, it is almost always going to be worthless. Most option contracts do expire worthless. There's a lot that expire with some amount of value, but a lot of option contracts also expire worthless. So we're going to talk a little bit more about why that is and what this kind of break-even cost is in the next couple of slides. Steven says max loss depends if the option is covered, correct? I don't exactly know what you mean by covered. I don't exactly know what you mean by covered, but if you're referring to like covered calls or like sell to open, that drastically changes what the max loss might look like. Sorry to ask again, but where did I see implied volatility? Yeah, Ivy, it's not something that I saw in what I was looking at. It's kind of just something that I know because NVIDIA is going into the earnings report today and just reported earnings. It is always going to have some amount of implied volatility going into earnings. And that implied volatility is always there. The market always thinks that the market will move some amount per week. However, into earnings, that implied volatility will always increase on any given equity, no matter what. You get when there are a ton of calls on the day or week and rest inputs expiring in the week after, will the stock go up or down? How do you know? When you see all calls, you tend to go on call and get burned. Yeah, so I think you're asking a question about options flow. Options flow is rather nuanced. So just because you see a lot of calls getting traded doesn't necessarily mean that people are looking for the stock to go up. One thing to be mindful of is options can be used as an instrument for what's called hedging. What you can think of a hedge is like insurance for your portfolio. Like for example, you get car insurance for your car in case you get in an accident. You could use options to hedge your portfolio in case of a market decline. So let's say I'm in a whole boatload of shares, right? I might want to trade a small amount of puts when the market reaches significant levels of resistance in order to protect my portfolio from any downside, which is something you actually saw Tilio do in his tab just a couple of days ago, where he was noticing the market was seeing, some signs of retracement. So he got this spread, which ended up being a hedge, which I'm not going to talk about what a spread is right now. So let's ignore this -1 position and let's focus on the 500 put. So let's just say he bought the 500 put to open, probably as a hedge to protect his share portfolio and long options positions. So just something to be mindful of. There's a lot of reasons for people to be buying and selling options contracts. And just because somebody bought a lot of calls doesn't necessarily mean that they are bullish on the stock. So really important to be mindful of that. Options flow is really nuanced, and we'll probably have a lecture talking about it a little bit more, but it's definitely a longer discussion. NVIDIA always goes up after ER though. Yeah, in recent times that's pretty much what it's done, but it definitely hasn't always done that. And I can even prove that to you, right? It's been going up pretty much every earnings report here, pretty much there. And it actually didn't go anywhere for this report, but this report it's obviously up big. But if we look at some older reports, definitely not always the case. Like earnings here, we get that move lower. Earnings here, we got to move up. Earnings here, move lower. And here, small move up. So hasn't always been the case for NVIDIA. All right. And moving on to some of what you mentioned earlier in the chat, some of these comments that I saw through. While a call option in this server, you'll generally see traded, or a put option, you'll generally see us. Let me restart that sentence. In this server and in a lot of the, I'll call it traded community, you will see most people buying and selling options. So they're going to buy the option for, say, $100, and the goal will be to sell it for a price higher than $100 in order to make a profit. However, that hasn't always been how options were used. And they actually have a, I'll call it, fundamental purpose behind them and reason that they exist. So a call option gives the owner of that option contract the right to purchase 100 shares at the strike price. And I'll introduce those terms in just a little bit. And a put option gives the owner the right to sell 100 shares at the strike price. So let's take a look at what that might look like for calls. For example, let's say I purchased calls with a strike price of $470. If I paid $500 for that contract, I would essentially break even if the stock price went up to 475. And the reasoning behind that is because my strike price is 470. I paid $500 for it. And as a result, I need to make $5 on my shares in order to make money. So let me just let's rephrase this a little bit. So purchasing a call at the strike price of $470 gives me, the owner of the call, the right to buy shares at $470 per share, which is pretty cool. So if the price increases to 500, I could exercise my contract and all of a sudden I have shares at $470. So if I pay, for example, $500 for this contract, I will break even on that, I'll call it return, if the stock price hits $475. Because if you think about it, this option gives me the right to buy 100 shares. If once the stock price increases by $5, 5 times 100 is 500, which is the same price that I paid. So any movement above 475 means I would effectively make money if I were to exercise the contract. So for example, if I had this option contract with a strike price of 470, I paid $500 for it, and the stock price hit 476, I could exercise that contract, which means I would pay the $500, that $500 would be gone, and I would also pay to buy shares at 470. I would be up a net of $100 total because I lose that $500 because that's gone. I exercise the contract. I have shares at 470, 100 of them, and the stock price is 475, 476, which means I'm up $6 per share times 100 shares, which is $600 in profit. I only paid 500 for the contract. So that means I am now up $100. And that money would go grow in returns as stock price appreciates more and more. And at that point, it's like I just own shares normally. Now, as I mentioned, exercising contracts isn't really something that you're going to see done at all in here. I don't know if there's ever been an analyst that's alerted to exercise a contract. Maybe Tilia once, and he said he was doing it for himself, but it's really not something that you see commonly done here. But this is what this term break even means. So, for example, when you purchase a contract, you might see that break even price. This is what that break even price is referring to. So, if you were to exercise it, the stock price would need to move to that level for you to break even on your exercise. And similarly for puts, let's say, for example, I have a contract with a strike price of $430, which I just put a red line here. And if I pay $300 for that contract, this contract gives me the right to sell shares at 430. So let's say I own 100 shares of SPY. I purchased the $430 put or 430 strike price put because I think the stock price might go down, but I still want to sell my shares or I still want to be protected. What I could do is, let's say, for example, the stock price begins to drop. I could decide to exercise my contract and essentially sell my shares at a higher price. So if I own that 430 put and the stock price drops all the way to 370, I can exercise my contract to sell my shares at 430. Also, I'll have a massive profit on that put contract, so I could also sell the contract for profit as well. So important to note, and same with the calls example, right? This is only referring to kind of that P&L curve for exercising your contracts, right? If, let's say, for example, I purchased that 470 call and an hour later, the stock price went to 475, I could also sell that contract for a big amount of profit. I'll be up a lot of money at that point. So I could just sell the contract for profit. So moving back to the put example, again, puts give me the right to sell 100 shares at the strike price. So again, if the strike price is 430, let's say the stock price drops to 300, I could exercise that contract and my shares would be sold at 430. And the break even, as it stands for exercising, works in a similar manner. So let's say I pay $300 for this contract. Remember that the put contract gives me the right to sell 100 shares. So in order to break even, let's say I own 100 shares, I need the stock price to break or move $3 per share lower, which would result in me losing $300, which would be my break even. So now I would be insured to sell my shares at a higher price. And let's say the stock drops all the way to 420 and I decide to sell my shares using this option contract, I would make $700 more than I would have if I just sold at 420. Because if you think about it, if I have my shares at 430, or if I have my contract at 430, the stock price drops to 420. I'm down $10 per share. If I own 100 shares, that's $1,000. So I'd be down $1,000. But if I own this put contract, I'm only down, let's say, $300 because that money left my portfolio to buy the put contract. But I'd be able to use that put contract to recuperate $700 net because I'd be able to sell for $10 more a share than I would have. Hopefully that makes sense. I'll take a look to answer some of the questions. Teresa, so are you looking for somebody for someone willing to buy for 476 and above, and then you can sell for profit? Yeah. So hopefully my kind of clarification related to clearing up kind of the difference between exercising and selling for profit made cleared that one up for you, but let me know if it didn't. What about if you bought a contract and goes up to 6? Or if you bought a contract at 20 and it goes up to 6, how much would each shares be, or how much of a discount would you get? You get an extreme discount. And you also have to remember that your option contract would also be up massively. And sometimes it might just make sense to sell the contract for the profit rather than purchasing the shares. Why would anybody pay to buy a put if the company goes bankrupt? Does that make sense? Yeah. So interesting question. If the company goes bankrupt and ends up delisted from the market, you might not get any money. And that's something that we saw happen with the bank failures where some people that had puts just lost their money. Even though the company went bankrupt, it's just the mechanism by how it happened. There was I think it was something with Robinhood, since you can't exercise options on things that it was this whole situation. I still don't really fully understand exactly what happened there. But sometimes you lose your money. And that's, I don't think how things are supposed to happen, but sometimes that's how it works. But if the company does go bankrupt and you're holding puts, generally speaking, you should get some form of compensation. And I don't exactly know the mechanics behind how it works. I've never been in that situation and I don't really ever plan to be, so I never really have had to learn much about it. But it's an interesting question. Honestly, we might have to revisit that and I can look a little bit more into specifically what happens, because I don't think I can speak on it with much confidence right now. Yeah, Teresa, I can revisit the put example again, and I can probably write a little bit more on the chart here to make it a bit more clear. So going back into the put example here, let's say I own shares at actually, it doesn't matter where we own the shares. So share price drops from 430 to 420. I own 100 shares. So 100 times a $10 drop in share price equals, let's change this, is minus $1,000, right? Because the stock price has dropped $10. I own 100 shares, so $10 per share means I am down $1,000 on my investment just from this period alone. However, and that's what would happen. So let's say, for example, the price drops and I decide to sell because I didn't have a put contract and I had no insurance in my portfolio. So I just said, okay, well, the price dropped from 430 to 420. So I'm just going to sell now and take the $1,000 loss. Now, if I own the 430 strike price put, in order to get it, I need to pay $300 to get the put. And then if the stock price drops to 420, right? So stock drops to 420, I can exercise the put contract to sell at 430. So it's like I'm selling at $430, but the stock price is actually at 420. And again, if you remember, the amount of money that I lost when stock price dropped from 430 to 420 was $1,000. That's completely gone because now it's like I'm selling at 430. So this negative $1,000 is gone. And now the amount of money that I lose is only the strike price, which is $300, or excuse me, the price to purchase the option contract, which is $300. So instead of being down $1,000, I'm only down $300, which is the price that I paid to purchase the option contract. So does that clear things up a little bit for you, Teresa? And again, the kind of exercising options contract is super nuanced, and it's not something that's commonly done. What we see more commonly around here is people buying and selling the puts in order to mitigate any impacts from a drop. But this is just kind of the fundamental purpose behind contracts. Ari says, what happens when you have option contracts and they expire, but you do not sell? Yeah, very interesting question. So if you have open contracts, when they expire, there's two things that can happen. If they're in the money and you have enough cash to exercise the contract, there's a chance that they will be automatically exercised by your brokerage. You can turn this off, I think, and make it automatically sell instead. But if you're swinging a contract into expiration and you have enough money to exercise it, and the setting is just enabled in your brokerage, it's just going to get exercised automatically. If you do not have enough money, it's going to be sold before the market closes. And finally, if the contract expires worthless, nothing happens. So you don't exercise, it goes to zero and it disappears from your portfolio. So if you have a put contract and the share price goes down, you can exercise to max profit. So Teresa, you are correct. You are absolutely correct. What I'm talking about is exercising the put contract. So just to remind you, you are right. If you are buying to open either a call or put option, you will generally make money when the stock moves in your direction. What I'm referring to is what happens when you exercise the contracts, which is really just not super useful. Most people won't really ever exercise a contract. It's just something to be mindful of when trading options. And it just is helpful to know this kind of fundamental understanding of why these contracts exist. But that said, you are correct. If you are in a put contract and the stock price decreases, you generally will be in profit. So you're right. All right. So I just realized what time it is. We got a lot to cover still. So I'm going to probably start moving a little bit quicker to make sure we get through it all. So I have this little graphic here, which kind of shows the different pieces of kind of buying and selling. The one thing to remember about the stock market is it's a zero-sum game. So if you are buying to open an option contract, there's somebody who is selling to open that same contract to you. And somebody that sells has different obligations than somebody that buys. So I would recommend just taking a screenshot of this chart, taking a look at it later. I'm not going to cover too much, but just remember, important to know, the market is a zero-sum game. When you exercise that contract, the shares are bought or sold by the counterparty. So important to note that. So getting into the properties of an option contract, this is what it looks like on the Robinhood interface. It's going to look a little bit different on different brokerages, but these general features are shown on all different brokerages. So here you can see the ticker at the top. We have our strike price, which is 400. It lists if it's a call or a put. It shows us our purchase price, the current price of the contract, the expiration, and our gain or loss. Now, can anybody tell me why the purchase price looks like it's 8 cents, but the market value looks like it's $8? Does anybody know why that's the case? Beautiful. Everybody's right. Exactly. Yes, the option contract represents 100 shares. For some reason, and I don't know why this is the case, but the price is just shown per share. So it costs 8 cents per share to buy this contract, but an option contract represents 100 shares. So you have to multiply that listed cost by 100 to figure out the true price. Great job. And you can see that illustrated a little bit more clearly here. This is TD Ameritrade. Oops, I want to fix this. This was broken last time. All right, much better. This is TD Ameritrade, so you can kind of see how it looks a bit differently in different interfaces, but all the same properties are here. So you can see the ticker, the expiration date, the strike price. It lists if it's a call or a put. It shows what you purchased the contract at, the current price of the contract, your gain or loss, and it also shows the current value of the contract here. So you can see down here, it looks like the current value is $4.45, but the actual current value is $445. And it looks like the current gain is 25 cents because we purchased at 420. It's now 445, but that's actually $25 again because we're multiplying by 100 to represent the number of shares. And you can see this reflected just because I'm looking at Tilio's tab. Same thing up. Oops, well, it's full screen. But anyway, it's going to look different in different brokerages. You can see this. I know a lot of our analysts are posting this type of stuff. So yeah, you can see it all over the place. Yeah, it's going to look different in different brokerages. Now, in terms of purchasing an option contract, again, this is another thing that's going to look different in different brokerages. So important to note that what you're seeing here might not be how it works for you. And this is also a pretty old screenshot from Robinhood too. It's one from a couple years ago. So it might not even, I mean, actually, I know the interface looks pretty similar, but essentially when you're purchasing an option contract, you open up what's called the options chain here, which lists all the options available, all the calls and all the puts and all the expirations available. You come into this window when you select one, and you're able to put in a price and a quantity. And you'll notice again, this bid and ask price. And this brings us back to that auction market concept where we have the bid, which is the largest amount of money that buyers are willing to pay. And we have the ask, which is the lowest amount of money that sellers are willing to sell their contract for. And one thing to note is if you want to purchase an option contract instantly, you can fill at the ask. So if I wanted to buy this contract instantly, I'd put in 0.62 here. And the reason that fills me instantly is because in this present moment, there is a seller with their contract listed on the market for 62 bucks. If I put my price at the bid, it might take me a little bit longer because there's not currently any sellers selling there. That's the best buy price, but that doesn't mean that there's any sellers at that same area. So it might take a little bit longer when filling at the bid or in the middle of these two values rather than the ask. So another thing to be mindful of there. And again, this is just another view here. This is TD Ameritrade, which I don't even know how many people use this anymore. This is just giving another example of what the option chain might look like. So you can see here, we have the expiration listed here. On the left is all the bids, on the right is all the asks, and these are all the calls. And this column here is all the puts. So just a different way of displaying things, but still things to be mindful of. And you can see here the kind of columns at the top. Whatever brokerage you end up using, there's going to be specific kind of nuances to it, whether it's Robinhood or Webull or TD Ameritrade or iBroker or I don't know, TC 2000. I don't even know if that's brokerage, but anyway, a lot of different ways that these types of information and option contracts are displayed. So it's impossible to cover every single one in this lecture, but these are the general rules of thumb. Like generally, when you open the option contract, you see a list of strikes, you see a list of expirations, you see the bid, you see the ask, and in this case, you can also see the volume and the open interest, which I'm not going to cover today. We're going to focus more on that next week. So I want to introduce a couple more concepts, and I just noticed that I is lowercase, so I want to fix that because it's going to bother me. Thinkorswim, is that a platform only? Yeah, so Thinkorswim you can actually trade on. It's made by TD Ameritrade, which is now Schwab. So you can actually trade on here. So for example, if you look on here, I could buy and sell option contracts on this specific brokerage, and it's connected to my Schwab account now, not my TD Ameritrade account anymore. So yes, you can absolutely buy and sell from Thinkorswim, and it's generally our preferred platform, but that doesn't mean that you have to use it. All right, so a couple different ways to describe an option contract. So there's three main terms to get out here, and this slide is a little bit more cluttered than I like, so this is something that maybe could be reworked. But three different ways to describe a call option, for example. In the money, out of the money, and at the money. An in the money call is when the stock price is higher than the strike price of a call contract. Out of the money is when the stock price is lower than the strike price of a call contract. And at the money is when the stock price is equal or very close to the strike price of the contract. The way that I remembered these when I was first learning them is I thought about the fundamental purpose of an option contract, which is exercising. And in order for us to make money when we exercise a call, we are generally going to want that call to be in the money. Because if you think about it, if a call is in the money, that means the current price of the stock is above our strike price, which is what we want when we're exercising, right? For example, if you think back to that example where we thought about that 470 strike price and that 476 stock price, that would be an example of a call that is in the money because the stock price is above the strike price of the contract. So in the money, if you're exercising calls, is good, which is why that's kind of how I remember that. And out of the money is when the stock price is lower than the strike price of the contract. So for example, thinking back to our example earlier, if the strike price of the contract I was in was 470 and it was a call, and the current stock price was 460, that means that call is out of the money. So if I decided to exercise that call, right? Remember the strike price is 470, the stock price is 460. Exercising the 470 call would give me the right to buy shares at 470 when the stock is currently trading at 460, which makes no sense, right? And just I'll even navigate back to our example so we can kind of visualize that. What that would look like is, again, the strike price is 470, but let's say the stock is trading at 440, right? That would give me the right to buy shares $30 more expensive than what the price of shares currently is, which makes no sense, right? Which is how I like to remember out of the money. Is out of the money is essentially I can't really do anything with it for exercising. Now you can completely make money on in the money or out of the money contracts if trading them. It's just exercising is what helped me remember those. And then finally, at the money is pretty simple. It's the same for both calls and puts. At the money is essentially when the stock price is very close to the strike price. So just covering what that looks like for calls and puts. If we go back to our options chain example, you can see here the current stock price was $299. So our 300 call or the 297.50 call would be the at the money because those are the two closest strike prices to our current stock price. And then next, our in the money calls are the strikes below the current stock price. So anything below 299 would be considered in the money. So that 297.50 could be either in the money or at the money. And everything below that is going to be in the money. Because if you think about it, for example, if we held a call that was the $285 strike price and the stock was trading at 299, we could make money on that if we had held that for a little while because we could exercise it and get shares for cheaper. And conversely, the out of the money calls are above the current stock price because we can't do anything with them. And puts is the exact opposite. And thinking back to what we do when we exercise puts, puts give us the right to sell shares. So when the stock price or when our strike price is lower than the current stock price, a put is out of the money. Because, for example, why would I exercise a 285 strike price put when the stock price is at 299? That would mean that I am deciding to sell shares for cheaper than they currently are. Like I could sell shares for 299 instantly, or I could exercise a 285 call and lose money. It makes no sense. So that's how I like to remember the out of the money is just remembering what doesn't make any sense and remembering that out of the money for puts is opposite for out of the money to calls and inverse in the money. So again, in the money puts are above the current stock price. Same analogy, right? If I'm looking to sell shares based on exercising a contract, I want that strike price to be higher than the current stock price because I want to sell shares for a higher price than they currently are, which is what I can do with an in the money put. So I want to move into a little bit of an example, and I know I'm kind of moving quick as we're kind of nearing the end of our time slot here, but I just want to give a couple examples that help reinforce these concepts, and then we'll be done here. So just 2 total questions with 4 or 5 different scenarios, and then we'll be good to go. So let's finish strong. All right, so I'm going to present a couple scenarios and just ask that you guys respond in the chat, and yeah, do your best. So question number 1. I have a call contract of SPY. The strike price is $3.95. SPY is currently trading at $412.24. Is this contract out of the money, at the money, or in the money? Go ahead and throw your answers in the chat. And I won't say if anybody's right or not. We got a couple answers coming through. Seems like people are agreeing. We got a lot of agreement. Hopefully you guys are right. Yeah, honestly, every single one of you guys are right. I'm surprised that not a single person said out of the money. I know somebody probably thought out of the money, and that's okay. But that's the first time I haven't seen anybody type the wrong answer for this question. Somebody always types the wrong answer at least. So nice job, everybody. Yes, this one is in the money because the stock price is way above our strike price. And yeah, Christian, I hope you trimmed. I really do. Unless you bought it after the move already happened way above 395, then you're just kind of nuts. All right, next question. I have a call contract to SPY. The strike price is 412. SPY is currently trading at 412. So strike price 412, stock price is 412. Is this contract out of the money, at the money, or in the money? What do we think? All right. Everybody is agreeing. Yes, I agree with you all as well. This one is definitely at the money. It's perfectly at the money. If the stock price was 413 or 411, I'd probably still call it at the money. It's just so close that you might as well just call it at the money, right? So there's kind of a reasonable threshold where it's out of the money or it's at the money or it's something else. So if it's like, yeah, so things to be mindful of. Okay, this last question, it's not a trick question, but read carefully and listen carefully because you'll get it wrong if you don't listen carefully. I have a put contract of SPY, not a call, a put contract. The strike price is 420. SPY is currently trading at 412. Is this contract out of the money, at the money, or in the money? Remember what we want to do with put contracts. We want to sell shares. We want to sell the shares. What do we think? Couple more answers. It's okay to not agree with the crowd too. If you think it's something different, don't worry about it. The crowd might be wrong. All right. So yes, this one is in the money. And we got one, Laro saying out of the money, not a problem. This one is confusing because it's more intuitive, I think, to think about calls rather than puts. But remember why we're trading, or not trading, but what the purpose of exercising those put contracts is, which is to sell shares. So for example, the strike price is 420, which means we have the right to sell shares at 420. When the price of SPY is currently 412, that means we can sell shares at a higher price, which for puts, that's good, right? Which the way I remember that is that's in the money. If I can do something good with it, it's in the money. And if I can't do anything good with it, it's out of the money. And if it's like right in the middle, it's at the money. That's the way I remember it. But hopefully that clears that up. If you guys still have questions on in the money, at the money, or out of the money, feel free to let me know. Okay, last section. I want to talk about the two big components that make up the premium of an option contract. And we'll break this down more into the next lecture. It's just a really good segue into next week. So I want to just break this down really quick. And this is something that you'd probably see in a college class on options. So I had to add it. I had to add it in. So there's two main components that give an option contract value. There's the extrinsic value, which is comprised of time value and implied volatility. And there's the intrinsic value, which is the amount the contract is in the money, which the way I remember intrinsic value is, again, in the money, right? Intrinsic in the money. That's the way I remember it. So let's walk through an example on how to calculate this. And I'm not going to make you guys do this math in your head, so let's walk through this. Going back to scenario one, if we have a call contract to SPY and the strike price is 395, when SPY is currently trading at 412.24. Let's say the ask price of this contract is 24.59. We can calculate the intrinsic value by determining how deep this contract is in the money, which we can subtract the strike price from the current price, which gives us $17.24. So the contract is $17.24 in the money because SPY is $17.24 above the strike price. Again, we always multiply by 100 to keep our 100 shares, which means the intrinsic value is $1,724. That intrinsic value is maintained after a contract expires. So if the stock price went nowhere for the next however many days and expired, we know that that contract would be worth $1,722 or $24. The way we can determine our intrinsic or extrinsic value is subtracting the IV intrinsic value from the total premium, because extrinsic value is a lot more difficult to calculate. It's essentially determined by our options Greeks, which are a very advanced mathematical, I'll call it a model. It's just very sophisticated, and there's no way you're ever really going to calculate that. At least with a standard scientific calculator, you're going to need some more special stuff. So the best way to determine what the extrinsic value is just subtracting the intrinsic from the total premium, giving us an extrinsic value of $735. And the way I remember extrinsic value is it's things that aren't related to the fundamental purpose of an option contract, which the fundamental purpose of an option contract, the reason it exists is to exercise it. As a reminder, we trade options, we buy and sell them. We don't really exercise them, but the fundamental purpose still is to exercise. So what this extrinsic value means is there's $735 worth of value on this contract because of the implied volatility, as well as the amount of time that it has until the contract expires. And as we get closer to expiration, this extrinsic value will drop. But if we go further in the money, the intrinsic value will increase. So hopefully that makes sense. Last thing. There's a lot of advanced option strategies that we have no time to talk about in the beginner's course series because it just really gets in depth and not super common. But a lot of strategies are based on selling to open calls or puts. So being on the other side of the coin, rather than buying to open, you're the one that sells to somebody else. There's also spreads, which again, I showed you Tilio's tab earlier, where he bought one call and sold another, or excuse me, bought one put and sold another. That'd be a spread. There's also more sophisticated option strategies where you buy and sell a combination of 4 different contracts. Yeah, Butterfly, Norman, where I think that's 3 contracts or maybe 4 still. Bunch of different crazy option strategies that you can do. We're not going to cover those in the beginner's course series. We have some lectures on selling premium and spreads, but not something that's relevant to the beginner's course series and not something that is done here very often. That said, I'm assuming we've covered most of the questions here. And I want to summarize. I couldn't remember where we were at. Oops. I just realized. Sorry, I didn't finish that. Yeah, sorry. So today we learned in class the basics of option contracts. Oh man, I forgot to revise this slide. Sorry, everybody. We learned the basics of option contracts. I'm updating it as we go, so excuse the non-professionalism. We learned the basics of the stock market, and the basics of options contracts. In the next lecture, try and get rid of that, we will go over the Greeks. Guess I forgot to update this section. That's a miss on my part. So yes, in the next lecture, we are going to talk about the Greeks of options, and we're also going to talk a little bit about selecting options contracts. So again, just to recap, as I mentioned at the beginning of the lecture, at this point, you should have a good understanding of how the market works, or at least a good basic understanding. And you should also have a reasonable understanding of what options are, how they move, what they do, what their purpose is, and how to understand, how to calculate different values and understand in the money, out of the money, and at the money, those different terms. So that brings us to the conclusion of this first class. I'm going to stick around for a couple minutes to answer any questions or comments. But I hope you guys all truly enjoyed. I really appreciate you guys all being here, and I really hope to see you all in the next lecture. We have 12 lectures of this stuff, and it's only going to get more difficult. It's only going to get more detailed. And yeah, I'm really hoping you guys all enjoy it. We've gotten some really good reviews on this class in the past. If you guys have any feedback, positive or negative, on this class or any future contracts, I really hope that you would let me know, because although I try my best to read your minds, I can't all the time. So you have to let me know if I covered something in a way that didn't work for you, or if you wish that I presented things in a different way. So go ahead and give me as much feedback as you like, and I will be happy to improve and perfect the next lecture. Yeah, Javier. Or Xavier, very quick. I know it's so hard. I try my best to find the balance between a quick pace and also slow enough to cover everything adequately. This lecture in specific, there's a lot to cover, so I kind of have to move a bit quicker. But in the next couple, we'll be able to slow down a little bit. So, or at least I'll try to. So yeah, I apologize if it was a little bit too quick, and that's feedback that I've gotten before. Sometimes I'm just a little bit fast. So I'll do my best to slow down. The next beginner lecture, I think, is going to be Um, Monday, but we'll see. Awesome, everybody. Well, hey, I really appreciate everybody's attendance. If this was your first lecture with me, I truly hope you enjoyed. And I really hope to see you guys all in the next one. And yeah, hope you have a great night. I'll see you guys all on the trade floor tomorrow. And yeah, let's make some money. See you guys.